Dave, yeah, congratulations. You moved with stunning speed to capitalize on this banking crisis. Tell us about this big bank ETF launching tomorrow. What's in it?
Yeah, Bob, you're absolutely right. There's been a lot of question marks about the financial sector. And what we've been hearing from investors for years is looking for opportunities for more precision than is available today. And what the big bank ETF is, it's exposure to 6 banks, the largest and most liquid banks in the US. And so that's Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, JP Morgan, and Wells Fargo. And again, these are the banks that actually stand to benefit from this turmoil and that we believe actually are going to offer investors potentially the opportunity to do better than what we have seen, of course, with the regional banks today.
And I see you've got here, we're putting up a full screen here. You have an expense ratio of 0.29%. And that expense ratio compares favorably, Todd, with the expense ratio of the bank ETF, the KBE. I think it's 0.35%. You know, Todd, I really marvel at how quickly the ETF industry can capitalize on these hot investing trends. It really is something. Remember, we saw this we've seen this many times. We saw this with pot ETFs. We saw this with thematic tech ETFs. With cybersecurity, social media. We saw this with crypto. And investors pile in when it's a hot topic, but these hot topics often underperform a year later. So explain to us how we should sort of look at these products. It's marvelous to see how quickly the ETF industry moves, but should investors necessarily jump on everything like this?
So no, investors shouldn't just jump to this just because banks are in the news and both the good and the bad that comes with it. You really want to do some due diligence, make sure those 6 banks that Dave was talking about is important. At VettaFi, we're seeing greater interest in financial ETFs in particular. In fact, from a sector ETF perspective, more than 50% of our traffic on our website was towards financial ETFs, really? Over energy, over technology. But you want to make sure that you're researching for the right reasons. You could either be buying, you could be selling. You shouldn't just go into financials just because it's making the headlines. In fact, that might be a reason of risk why you may want to steer clear of financials because you have it within your portfolio.
I get this all the time from our viewers who, when we talk about IPOs on the day, and then, of course, they pop on one day, and then 6 months later, they're lower. Dave, you know what I'm talking about. Why is now necessarily a good time to invest in banks, given all the increased regulation and higher costs?
Well, it's interesting. We don't believe that investments in the banking sector is actually a trend, right? We're talking about names in this particular case that are mega caps that actually have exposure and to diversified business lines, whether that's traditional deposit banking in the case of Bank of America or Wells Fargo, or really leading investment banking franchises in the case of Morgan Stanley and Goldman Sachs. But what's interesting here is that a lot of firms had calls on regional banks doing well into the year. I don't think many could have predicted the turmoil that we're seeing today. But in a crisis of confidence, where really investors are going and picking and choosing any areas of weakness, whether that's Silicon Valley Bank or Credit Suisse, the idea that investors are now going to have the opportunity to gain that financial exposure without the dilution that they're going to get potentially with other financial ETFs, I think is really exciting. And that's one of the reasons why we looked to bring the big bank ETF, a big B to market tomorrow.
You know, Todd, the investors in these sector bets, banks or energy, whatever, I think it's a good time to realize that they may be more exposed than they think of to certain things. For example, just this bank thing. Value is the largest, banks, financials are the largest sector in value ETFs. Vanguard Value is 20% financials. iShares S&P Value is almost 20%. So investors, if they own certain sectors, even if it doesn't say financials, they may be very much exposed. This is sort of like a teaching moment. My point is to explain to people understanding what you own here.
That's right. So financials is one of the larger sectors within the broader marketplace, but in value ETFs in particular, it's the heavyweight. That's where people tend to turn undervalued companies like JP Morgan, Bank of America. So with these ETFs, sector ETFs in general, and more concentrated ETFs, you really want to make sure you want to overweight. That now is, according to you as an investor, is a great time to be overexposed to these companies. These are more concentrated. That comes with the pluses, that comes with the minuses, but make sure you know what's inside your ETF.